Your Ty's or Jay's birthday.
Oh, that's right. Is it your birthday today, Jay?
It is 21, finally.
Nice to see you got your clip-on tie today, so me too.
Not sure the last time that I wore a tie.
Had to get the dust off. I have all these nice ties that never get any daylight.
Well, you look good nonetheless, so happy birthday, Jay.
Thank you, guys. So we've made it this far. We're episode 10 of year one of the Wealth Talk podcast. I think off the top, I want to just say thanks to everyone who's supported us and given us some feedback. And we do invite you to keep those comments coming. If there's anything you want us to discuss, please let us know. Otherwise, episode 10, Wealth Talk, unraveling current events and market trends with Plena Wealth Advisors. As always, we're joined up in Kelowna by Craig White, here in Vancouver by Clark Linton. And again, our goal of this podcast is to provide a window into our conversations about the markets, the economy, and any other topics that may impact our offering to clients. A lot's happened in the last 30 days. One of the big things that I think happened that we're all a little bit cognizant of is Charlie Munger, one of the kind of greatest investors of all time. I think it goes without saying, passed away, unfortunately, at the ripe old age of 99, quite a life he lived. I think we'd all consider ourselves to some degree or another disciples of maybe not Charlie, but the Berkshire Hathaway investment maxims, and certainly follow what they do and how they behave more than anything. But I know we've all got some kind of good things to take away from what Charlie had to say over the years. What sticks out in your guys' minds that Charlie left us with?
I think, a lot of people probably have never heard of the name Charlie Munger. Warren Buffett, being the face of Berkshire Hathaway. So just for means of that reference, Charlie Munger was Warren Buffett's long-term business partner. He passed away at the age of 99. But again, Warren Buffett being the face of Berkshire, Charlie Munger didn't really get, as much headlines as he deserved. A couple of things I think I found interesting when I was looking at this over the last few weeks, that he passed away with a net worth of 2.3 billion or so. That was his estimated net worth. Warren Buffett over 100 billion. 2.3 billion. I still think that's a nice number. But why the big difference? And it's interesting. Warren Buffett, as a lot of people know, has pledged his net worth on his passing to charity, or a great deal of it. But historically had not given a lot of his wealth away. And in the early days, Charlie Munger gave a lot of his wealth away. So had a lot less money to accumulate and compound over the years as Warren Buffett did. Just a little lesson in, kind of sticking with a long-term goal, putting your money away, letting it compound, ignoring the short-term noise. A major difference. Craig, what are your thoughts on Charlie Munger? What stand out for you?
Yeah, I would echo those comments as well. I remember kind of back in the 90s when I took an interest in finance and economics. That's kind of, you talk about the Berkshire Hathaway, the models that they subscribe to. And, that kind of more or less was the foot that got me in the door, was reading about these two, highly respected and, extremely talented investors. And you talk about the kind of the philosophy that they followed, for more than, I think it's 50, 60 years now, that both of them involved with the Berkshire, in particular Buffett. And a couple of quotes that I recall. One is, kind of the big money is not in the buying and selling, but in the waiting. The other one would be, you don't have to be brilliant, only a little bit wiser than the other guys on average for a long, long time. And if you kind of go back to the message that the three of us and that we've always relayed to our clients, it's very similar to that. So I think a lot of successful investors nowadays, we attribute that to the Warren Buffetts and Charlie Mungers of the world.
What I would add to that is just, he was asked a few years ago, what would he attribute success to? What are the lessons to success? And he gave rather than a long-winded answer, he gave a one-word answer, which was rational. And we think about what's happened in the markets, particularly over the last couple of years, with bad headlines, good headlines, ups and downs, rising inflation. A lot of people tend to let the short run of these headlines affect them, which leads to some irrationality. And again, I think that's a really good reminder of their success came from a long-term view, as you said, Craig, but with coupling that with, rationality and not let the irrationality of short-term market movements get to you.
Well, look at the list of businesses that Berkshire Hathaway, the holding company, from Geico to insurance companies, from Coca-Cola to Apple, those are, I would argue, some of the best businesses in the world. And that's exactly how they view them, as businesses, not a piece of paper that's involved with trading on a daily or a weekly basis. They're business owners.
Yeah, and they really accumulated this unbelievable track record at Berkshire, not by applying some esoteric strategy that beats the market and promises all this additional upside. They really just stuck to owning good businesses, and as they have been extremely upfront about, they've made mistakes, they've invested in some businesses that didn't work out, but just owning really good businesses over long periods of time, which is something we come back to time and again, really has provided a tremendous amount of return over the decades. And there's just so much to take away. I think anyone who hasn't studied a little bit of Warren Buffett and Charlie and what they've had to say over the years, it's time well spent. There's a lot of life lessons in there too. Charlie was always a big believer that spending as much time of the day as possible reading and thinking was a large part of his success, which is as the three of us are raising kids these days, trying to encourage your kids to read and trying to encourage curiosity and those types of things. They apply in money management, but so many other places as well. And I think there's just so much to learn from both of them. And unfortunately, losing Charlie, it's going to be a big change to Berkshire and how they run their annual meeting, and something that a lot of us kind of financial junkies watch pretty closely. But pretty impressive life he lived, and a lot of wisdom in those 99 years. I'd like
to know when you find time to read, Jay, with busy with 2 kids. I find myself reading and falling asleep in my lap. So
it's telling your kids to read, I think, is the
right.
part, right? So lots happened last month. Obviously, last podcast we were talking about the market correction and kind of what had happened the previous 3 months. But boy, a lot has changed. Anyone want to kind of bring us up to speed on what's happened over the last 30 days or so here?
Yeah, I could provide a few thoughts. Certainly November was one of the strongest month we've seen for markets, and I would say specifically for portfolios. And it was, it's the bulk of most asset classes that we follow, from stocks, bonds, even commodities, saw a bit of a rally. If you go back to our comments over the fall, let's say, we've talked about these inflationary pressures that seem to be trending in the right direction. In other words, inflation's coming down. You've talked about bond markets telegraphing lower rates going forward, and that's really what occurred throughout late October all the way into more or less to where we are today, beginning of December here. Bond yields continue to come down, which is allowing asset prices to appreciate. And I think that's what we're looking out into is 2024, 2025, when rates should be lower. Inflationary pressures should be a tailwind, not a headwind, and asset prices should reaccelerate. That's probably the quickest, easiest take of what's happened. In addition to, we talked on our last podcast, was how negative sentiment actually was. And it's usually when everything's as negative as that is, you see a turning point for markets and for assets. And it kind of played out almost perfectly to the rhythm of the thing once again.
I agree there, Craig, with your comment about sentiment. It was extremely negative a month ago, and it's usually at times like that. We just talked a few minutes ago about irrationality in the market, people making irrational decisions in times like that, only to see, the next, month or two being extremely solid returns, as we saw last month in November. We've spoken a fair bit on these podcasts about, the reason for this correction that we've been in over the last almost 2 years, and it was really rising inflation, and as a result, rising interest rates. And we discussed that the catalyst for a recovery is going to be just the opposite, which is cooling inflation and the prospect of declining interest rates. And that's exactly what we're seeing now. Not only are inflation numbers coming in lower, but we're also seeing some economic data weakening, which, normally would be a negative thing. But this time around is a strong economy, an overheated economy, is is a cause of inflation. We've seen consumer spending come down, which again is healthy from this perspective. And I think what the market's reading into these headlines now in this economic data is the Federal Reserve in the United States and most central banks around the world are probably near, or if not at, the peak of their interest rate, hiking cycle. It's probably done. At least that, the reaction we saw in the markets this November or this month, to me is a clear indication that's the market's view now going forward. And the next move by the Federal Reserve and other central banks will likely be lower as opposed to higher.
Yeah, would it be best to say economically, it's kind of you hear it often, this Goldilocks type scenario where it's not too hot, it's not too cold. And really, you're seeing that manufacturing data continues to soften, as does housing, but consumption, which is about 70% of GDP, is still relatively okay. I'm not going to use the word strong, but it's chugging along. It's doing okay. And that's because, household debt to servicing levels, in particular in the US, have come down. It's still below where we were in 2008, 2009. Here in Canada, we've talked about it, we're more exposed to leverage and debt here. But if you look at all the components of what the National Bureau of Economic Research says defines an actual recession, I think that's 2 negative quarters of GDP. There's really only one that's standing out as a weak point, and that's industrial production. Real incomes, non-farm payroll, consumer spending, wholesale and retail sales remain buoyant. Things are actually okay.
Q3 earnings were also pretty strong. I mean, across the board in the US, we saw pretty much everything not everything, but the revenue numbers were better than expected. Earnings numbers are better than expected pretty much across the board, which is obviously helpful.
Yeah, take a company like Salesforce, which is a large portfolio holding of ours. Earlier this year, they had a series of layoffs in anticipation of some economic weakness, some other factors involved there as well. This quarter, they just came out with better than expected profits. They're hiring people back. That's management signaling that they're positive about the environment going forward. And I think we're going to see more of that. And again, that's a catalyst for a market recovery here.
I think one thing we ought to be a little bit careful about in terms of like interest rates. I mean, the market was pricing in a decline in interest rates for I think Q4 this year, which didn't materialize because of inflation being stickier than the central banks wanted to see it. But now the market's again pricing in interest rate reductions for next year, which if that comes to fruition, it probably aligns with continued degradation of economic data. And going back to Craig, your point, you want this kind of Goldilocks scenario where inflation is positive, but not so high that we need higher interest rates to cool things off. What we don't want to see is the economy start to decline. And in Canada here, we saw, a negative print again for GDP. In the US, it was still positive. But we want to kind of balance the economic performance to not heat inflation up too much again, where we've got concerns about continued rising interest rates, but we also don't want to have us fall into this deflationary economic contraction situation where we actually need lower interest rates, because if we're all of a sudden cutting interest rates next year, what that really means is the economy is softening more materially than what we've seen so far.
Well, we'll find out tomorrow, December 6th, when this podcast gets posted. Bank of Canada is going to come out with their most recent statement, and expectations are they're going to pause again. I think that's the third pause in a row now. But even Tiff Macklin's coming out and saying they're warming up to the idea, as you say, Jay, with rate cuts in 2024. And some market messaging is saying that's even possible April 2024. So, 4 or 5 months from where we are today, we may be talking a whole different ballgame for interest rates.
No, and I would peg it on a probability of an interest rate cut next year. I think it'll be needed. I don't think we're going back to zero where we've been, a few times over the last decade or two. It's not needed. But, one of the other things central banks have to worry about is our credit issues. Interest rates have moved up so high so quickly that you're seeing deterioration corporately on balance sheets with real estate projects. And I think just a little nudging down of interest rates, they don't have to go down a lot, but could send the right signal to the market that could, cause some, cooling there with some of those problems as well.
Yeah. So I think overall, just kind of wrap up a few comments on markets and portfolios. You've got some tailwinds now that are present that's supporting prices. The other thing we don't talk about is just how much cash is still sitting on the sidelines. I think recently I read that there's over $2 trillion of retail money market funds sitting idle. Certainly they're getting compensated on that from where they were a couple, 3 years ago. But eventually we feel that some of that finds its way back into assets, whether that's bonds, equities. It's not going to sit idle indefinitely. And the same on the institutional side. I think there's over $3 trillion of money market funds sitting idle. So you've got a few catalysts that can support things.
Down, right? Interest rates are coming down, that money's going to move pretty quickly. And that's all going to be buying power. So you can, it's easy to imagine this environment where interest rates soften a little bit, you get some of that money coming back into the market. And I mean, we're seasonality speaking, we've got a tailwind now. This Santa Claus rally hopefully materializes, and you see some strength in the market into the early spring there. Something else that happened over the last month is one of these kind of tech darling unicorns that we talked a lot about, or was kind of a big theme in the market over the last kind of 5-6 years here. WeWork declared bankruptcy, and this was a company that was about 10 years old, grew to a size of $64 billion valuation. So really, really quick ascent to becoming a very large and significant company. They operate shared office spaces. So here in Vancouver, they actually occupy the majority of one of the Bentall buildings, Bentall 3, I think it is, and anyone can rent out office space. And this was a company that got a lot of attention. A lot of people were falling all over themselves to invest in this, some very notable investors. And less than, I think, 3 years after going public, filed for Chapter 11 bankruptcy. And I'm guessing it will still exist in some form or another once they kind of reorganize their balance sheet. But I think just another great lesson of not wanting to chase the themes of the day, and going back to the Charlie Munger idea of being rational and recognizing that these businesses that are losing, I think at their peak, they were losing something like $16 billion a year in this kind of faulty business model, which is very alike to some of the other kind of disruptors that we've seen over the last number of years with Netflix and the streaming wars that's kind of de-aggregated everyone's cable packages. Or you kind of look at Uber, which promised to disrupt the taxi industry, and now we're kind of going full circle to where we kind of want the old cable packages back because we've all got 10 different streaming services that we're applying to. So I guess there's a lot of lessons here, but what do you guys think about their recent bankruptcy and kind of what we can learn and how we kind of manage money around these types of ideas?
I think it's a repeated cycle of hype, and you see, a thing like this come up. They're a disruptive company. They make a lot of splash. As a result, they're able to raise a lot of money. Keep in mind, as we just talked about, we came out of an environment over the last decade of ultra cheap money that allows these companies to expand it at any pace. Not only that, institutional investors are willing to borrow money at almost nothing and invest in venture companies like this. They make this splash, but they grow without any focus on profitability as well. And it's exactly what we saw with WeWork. We've seen it with other companies, like you said, Netflix, Uber, all these disruptors. And, again, this is not new. This is a repeated cycle of investors chasing hype. And you see the negative ramifications of that.
No, I don't think we're advocating here or messaging that Uber or Netflix is at risk of bankruptcy here, are we? It's just more of when you hear of, like, I think you're exactly right. Word there, Clark, you use is hype that you get around some of these themes that become prominent on social media, what have you. And you only have to rewind a few years ago when you had all these meme stops and GameStop and non-fungible tokens, stuff that's kind of beyond the realm of what we even focus on. But their lifespan is measured in months, or any performance attributed to them. You can go back to the cannabis craze of 2018-19. How many calls did we all field as portfolio managers about exposure to cannabis. And certainly if you timed it perfectly, there was some wealth created, but I'm going to say there's probably more wealth destruction over the past 3 years than wealth created from 17, 18, from relative to 2019 to today. Use some of the cannabis companies here in Canada that have lost upwards of 90% of their market value, market cap, and limited positive outlook going forward.
I think the other thing to look at with these companies, though, are the collateral damage in the economy. So if you look at WeWork, I think they had upwards of 18 million square feet of office space in North America. A lot of that, as a result, is going to sit empty for years to come. What does that mean for urban centers? What does that mean for real estate in general? You look at Uber, how disruptive it was to the taxi industry. I mean, try to find a taxi. Come out of a hotel or a restaurant late at night and there's no taxis around. What happens if Uber overspends? I would argue they are, and they change their business model, which they likely will as a result of costs going up. Less Uber drivers, but the taxi drivers aren't there anymore. You mentioned Netflix disrupting the cable industry, how difficult it's been for traditional cable companies. Netflix is now going that model where they're now starting, advertisements within Netflix. And it's, I think you also have to look at those kind of ramifications for other companies and industries as well.
Well, you look at probably the biggest disruptor that we've seen over the last 5-10 years is probably Tesla. The disruption that it's had in the automobile industry and where they are relative to 5 years ago. Competition breeds competition. And when you're at the top of the pack, competition sticks with you.
I think interesting story. And I think it, again, kind of pairs well with the talk about Charlie Munger and the way Berkshire operates and the barbell of companies that are highly profitable and highly reliable on one end that kind of end up falling into the Berkshire model, which certainly we subscribe to more closely. And then you've got these, unicorn type disruptors that promise very little in terms of profitability. I think as they mature, potentially a lot of these businesses will become more profitable. But it's these areas, these high growth, early nascent industries are fraught with problems and bankruptcies, as we've seen over the last number of years. So buyer beware for sure.
So would that be your takeaway message for the audience here, Jay, when we talk about this, names such as this or sectors or themes? What's your main takeaway?
I think you just have to be careful with these ideas. As you said, we're in a position where we're getting interest from clients into things that are on the front page of the newspaper, or their friends are telling them about, that they're making money investing in whatever the hot idea of the day is. And as kind of gatekeepers of conservative capital, we have a front row seat to all this destruction that ends up happening. And like you said, you kind of get those people that time it, that get in early, that make some money and get out at the right time. And they're few and far between relative to the people that were holding WeWork shares right till the bitter end, thinking that it was going to turn around in some way. So again, be more like Charlie Munger and less like the GameStop investors investing from their parents' basement.
I think conservative keepers of capital is a great way to say it. Why don't we kind of talk about the conservative response to the Liberals' fall economic statement that they had, they came out with a few weeks ago with our Minister of Finance. Clark, let's start with you. Your thoughts on the Liberal economic statement?
Conservative, prudent fiscal management by our Liberal government. God, where do I start with that? But, $20 billion worth of deficits. I mean, what is it this year? 40 billion. For those that are listening here that aren't aware of this, the Liberal government has run a deficit in every year since they've been in power. Not once have they run a surplus. And there's no change of that. I mean, they project now that they'll have a surplus in 2027. My guess is if they're still in power, they're not going to be having a surplus in 2027. I simply think that they have not exercised prudence. We shouldn't expect it. And, they, in good times and bad times, both, they have not been able to balance a budget. It's that simple. I don't know what else to say.
The irony of it all is the biggest component of this $40 billion of ongoing deficits is the cost of capital, is in fact the interest now that the government is forced to pay on all of the debt that they've issued over the past 8 years, et cetera, years. 2-3 years ago, if you remember, the same finance minister, Chrystia Freeland, came out and said they're not concerned about where interest rates are at or the ability for the Canadian government to quote unquote issue debt, print money. Well, that's coming back to bite them now, literally 24 months later. And as long as interest rates remain where they are right now, it's higher than where they issued that debt 3 years ago, 4 years ago, 5 years ago, 6 years ago, 8 years ago. That's the biggest impact to their deficit.
I'm going to elaborate a little bit on what you just mentioned there, Craig. What I'm going to paraphrase what Chrystia Freeland said a couple of years ago. It was in 2020.
There you go.
They were printing money like crazy. Now, a lot of that was COVID. You could argue for that, I guess. But justification for that at the time, in again, paraphrasing what she said, was it's fine if we're borrowing money here because, money is cheap, interest rates are low, our cost of capital is low. Now, 3 years later, when the cost of capital is high, their excuse for spending more money is the cost of borrowing is high. It's costing us more on this debt. Again, I don't think I can make it any simpler than that. It's just, in hindsight, 3 years ago, they made some decisions, and they made some decisions over the last number of years that, in my view, just have not been, that prudent of fiscal management.
Would have been really nice to see them issue some extremely long dated bonds. I think it was like the Dutch government or something was issuing like 100-year bonds at negative interest rates that help fund their government, and they don't have to worry about paying them back for 100 years, where all of the debt that Canada seemed to issue was within the next 10 years and now is going to be forced to refinance at significantly higher interest rates, cost Canadians more money, increase the debt, and you kind of get into this concerning, debt spiral where and we're not alone in this. I mean, it's not just the Canadian government that is using debt, unfortunately, to fund programs that, like you said, Clark, in one hand and during COVID were somewhat necessary, but now as we are still in a good global economic environment where Canada, unfortunately, seems to be slipping behind in competitiveness. We're still issuing more debt, taking on more deficits. We're increasing our $40 billion deficit by another $20 billion in the midst of a good economic environment. So you kind of, again, have to ask, what happens when we do go through that 2-year economic slowdown, when we do have some sort of significant recession, and all of a sudden tax receipts start to dry up and spending has to increase because unemployment insurance and other government programs need to be ramped up to help Canadians that are slipping through the cracks. I mean, it's just not a way to manage your government finances, your household finances, like we talk to clients about consistently. If you've got too much debt and you're continuing to pile it on, bad things are going to happen. So I guess my question is, like, at what point does this start to matter? I mean, we've still got a AAA credit rating. Our currency has, I would argue, held up relatively well, kind of in that, mid 70s area for the last couple of years. But when does our mismanagement start to come back to bite us?
Well, I'm going to challenge you here, Jay, a little bit, because the last couple of podcasts, I think we talked about Canada and its underperformance globally. And, one of the things you said a couple of times was, it doesn't take really a lot to consider, the positive effect that Canada could have, or, as an economy, that we don't really need a lot of change for Canada to flourish. And so when we have, these issues with government right now, with their spending, how does Canada change? What's going to be the catalyst for that?
Well, I think again, my point is there's the potential for change that could create a lot of economic prosperity in Canada. If you stop spending so much money that you don't have and you get your budget under control, right? If you can create a vibrant economy, which Canada has all the resources, the people, the land, the education, the system to do it. but you need to get back on the right track is the argument that I'm making. And I think it's possible to do that.
I just, the word imagine, right? I mean, we've been imagining for quite a while about the potential for Canada, and we just continue to see it. I just think that we have to have this isn't intended to be a political comment, but we need to have a government that is focused on innovation, on fiscal prudency. And we've got one right now that, to date has not, in my view, at least, illustrated that.
You're not going to get any disagreement from my end here. Yeah, it's we talked about it on a few podcasts ago. Is just support of the business community and regulations and red tape at the municipal, the provincial, at the federal level, supporting capitalism and open markets. And for us, that it seems like that window has closed over the last 5-10 years. Relative to an opportunity when you are spending a lot, you'd think it'd be going the other way. And unfortunately, you continue to see an exodus of smart capital from Canada, whether it's regulations, whether it's taxation. It's kind of similar to what you've seen with this movement of capital from California into states like Tennessee and Texas and Alabama, that has much more open markets. I think that's going to be the determining factor over the next couple of years here, and that's probably why you're starting to see the Conservatives, make some significant inroads on polls and what have you. And again, not meant to be a political statement, but I think a lot of people are feeling that after 7-8 years of where we've been with this Liberal government.
Well, what's really concerning is now the Canadian pension funds are actually asking for the lift on their restriction to invest entirely in Canada. So when you've got some of the biggest institutional investors in Canada looking to invest more money externally, you've got some issues at home.
Yeah, but you go back to kind of the heart of the issue that is really the anxiety amongst Canadians has been housing. That's top of the list, and then interest rates that are associated with the amount of debt that we've carried. So I don't know what the answer is today, but we certainly need more support on housing. You did see, some, I guess, a bit of a silver lining from the Liberal government with the fall economic statement, but that was stuff that was already released in the budget earlier this year. So it's just a regurgitation of previous policies that they've proposed. You just need to get interest rates under control, which seems to be the case. You need more support for lower income and middle income housing. And I don't know if that's going to be solved in the next 3 or 6 or 12 months. That's a structural change that we need to work through.
Any closing comments there, Clark?
No, I think I've said enough on this issue, actually. I'm at risk of saying more. So
maybe in one of our podcasts coming up, we can get someone we had Ed Mills back in June of this year talking about the environment within Washington, D.C. Be interested if we get someone out of Ottawa who can speak on behalf of kind of the inner workings of what's happening in the political environment.
Yeah, the one thing I would add, and I think I'm pretty pointed and negative in the comments that I made over the last few minutes, is that I should say that Canada is not alone. We're not the only country that's printed a lot of money, that's created some structural problems that is not great with innovation. We're definitely not alone, but I think this is our backyard here, and I think we have to be cognizant of these issues and hope and push for some change. As you've mentioned, Jay, and sorry to give you a hard time about it, but I mean, we do have a lot of potential here in Canada. It's just unfortunate that we're not taking full advantage of that. It's been years since we have, and I think that it would be great to see a period or an environment where we really flourish as a country and take advantage of what we have.
I like that positive note to end on. So again, want to say thanks everyone for sticking with us through the first year, and hope to be back better next year. And if there's anything you want us to discuss, please let us know. But otherwise, we'll wish everyone a happy holidays, and see you for the recap podcast early January 2024.
Jay, and I'll just make a quick comment. Thanks for being the the kind of moderator of these podcasts. You've done a great job over the last year. I know the feedback we've got from clients has been positive. So thanks for all your work in setting these up and putting Clark and I and all of us to test at least once a month. And from all of us here in Kelowna, happy holidays to everyone. Hopefully we get some downtime and opportunity to relax with friends and family. So we'll see you in 2024.
Thanks, everyone.
Thanks, guys.